Hello and welcome to Armbruster Capital Management's Invest Ed vidcast series. I'm Chris Cibula and I'm here with Mark Armbruster. Mark, in a tough economic environment, the stock market has had a stellar first half of the year.
Yes, sort of. It's certainly true that the S&P 500 was up a lot, 17% so far this year. But that's really only true at a very high sort of overall index level. Large U.S. growth stocks, driven mostly by the technology sector, did really, really well. International stocks were up a solid but much lower 12%. U.S. small cap stocks were up only 6%, and deep value stocks rose a paltry 1%. It was really the proverbial tale of two markets, the best of times for some, but really not so much for others.
Right, the market has been very narrow lately, with a relative handful of technology stocks contributing most of the growth. In fact, only 7 stocks, including Apple, Amazon, Meta, Microsoft, Nvidia, Tesla, and both share classes of Alphabet, rising over 60%, while the other 493 stocks in the S&P 500 rising only 6. Those 7 mostly tech stocks are such big companies that their price swings drive most of the index return, even in a big index like the S&P 500.
Yeah, talk about big stocks. Apple's total market value is over $3 trillion. Its stock market moves definitely impact the overall market. So clearly, diversification was a liability in the first half, and really over the past several years. You would have been far better off having all your money in U.S. technology stocks. That was also true in the Nifty 50 era of the 1970s, and again during the dot-com boom of the 1990s.
Yeah, but I wouldn't bet on that continuing. Diversification's benefits often come roaring back just at points when it appears most useless. The problem with today's market is that while tech stocks are dominant, there doesn't seem to be a good reason for it.
What about artificial intelligence making our economy more productive?
That probably will come to pass, but I wouldn't count on that in the short run. The internet made similar promises in the 1990s, which have largely come true, but the trend in economic growth hasn't changed meaningfully, and we still had a dire bear market in the early 2000s as the dot-com bubble burst.
Right, and the fundamentals seem to be deteriorating for many tech stocks. Revenue has been in a multi-year decline, and layoffs in the tech sector have been substantial in the past year. So valuations are rising just as the economic underpinnings of these stocks are deteriorating. That just doesn't make sense.
By the numbers, the price-to-earnings ratio for the overall stock market is around 23. That's pretty high when compared to historical norms. It's even worse for growth stocks, which are dominated by the tech sector. Their PE ratio is about 34. That makes the stock market expensive and likely overvalued. However, there are a number of bargains in today's market. Large cap value stocks have a PE of around 11, small cap value stocks trade around a PE of 9, and international value stocks are similarly cheap. These value stocks are generally real companies with real earnings.
Yeah, their growth may be anemic or they may be in less sexy industries, but when a downturn comes, as it did in the wake of the Nifty 50 and dot-com eras, I'd much rather be invested in real companies that trade at reasonable levels. In fact, when the dot-com boom turned to bust from March of 2000 through September of 2002, value stocks actually rose by 14%, while the S&P 500 fell 38% and the tech-heavy NASDAQ index lost an astounding 74%.
It does seem a little scary out there. When looking at relative performance, the tech sector is at almost exactly the same point versus the overall stock market that it was during the peak of the Nifty 50 and dot-com boom eras. Those prior periods ended badly for tech stocks. Could this time really be different?
Don't bet on it. That doesn't necessarily mean we're due for a huge correction or an economic crisis, though I wouldn't rule that out. However, high valuations very likely mean that we're in a period of slow growth for the stock market, the last 6 months notwithstanding. That could last for the better part of a decade, and we're likely in the early stages.
And the way to address that from an investment perspective is to rely on diversification, even if it hasn't looked so smart recently. Just as value stocks held up in the downturn of the early 2000s, it seems likely that they are again well positioned to weather the storm. Lower volatility stocks should also do well.
Yes, the historical data indicate that a diversified factor strategy, including value, low volatility stocks, high momentum stocks, and companies that have strong, consistent earnings fare quite well during periods when the overall stock market struggles.
It may still take some time until the tide turns, but it seems certain that it will. Being diversified could leave some money on the table if the mania continues, but as a longer-term strategy, it seems far more prudent than betting on the tech mania to continue. Thank you for joining us today. Please feel free to reach out with any questions or comments you have about this or any other investment topic.